In this video lesson, we'll be discussing what a short squeeze is and how to profit off such a move. But first, we must gain a better understanding of what short selling is in order to evaluate what actually occurs during a short squeeze. Short selling is a strategy that attempts to capitalize on the decline in share value by selling stock first and repurchasing it back at a later date. Obviously, when short selling, you're attempting to short the stock at a higher level and later repurchase it at a lower level. This is how profit is made by the short seller, by selling high and buying back lower. Now, the appeal of selling short is easy to understand, as we've seen in the past few years how stocks typically fall much faster than they rise. But of course, as with any strategy that is a straight directional bet, there are risks involved. The biggest risk to a short seller is that instead of the stock price dropping, the stock price actually rises. As we will see later from a few examples, a rising share price in a stock that is heavily shorted can often lead to a dramatic upward move, as losses mount in the accounts of those who are short, as they are then forced to exit their short positions by buying the stock back at whatever prices they can get. It should be noted that once a stock has been sold short, those short sellers represent future demand because they must buy the stock back at some future date. Now, typically that does not cause any issue in price action, especially when that trade works. However, in certain instances, when the stock makes a surge upwards, things can get quickly ugly for short sellers. The motivation for short sellers to buy back the stock so quickly and recklessly is often the fear of unlimited losses. For instance, when you buy a stock at $50 a share, the most you can lose is your entire investment of $50 per share. However, when you sell a stock short at $50 per share, the potential for losses, in theory at least, is unlimited. The stock can rise to $100 per share, which will result in a 100% loss of your capital. But what prevents the stock from rising to $200, $400, or even $600 per share? It is that fear of such an appreciation that gets those shorts to frantically head for the exits. But why don't some of these short sellers simply ride out the wave of buying pressure caused by others covering their positions? Simple. They often do not have the choice, as they are margin called on their short position. Margin called means the entity in which you have borrowed money from to execute on the position now demands you either exit the unsuccessful position right away or put more funds in immediately in order to hold on to that high-risk position. Typically, that entity is your trading firm, clearinghouse, or broker that you have placed the order through. So why don't people just use their own money when short selling? Well, since those who are short are actually borrowing shares from someone else in an attempt to return those shares at a later date, a substantial amount of money often must be put up to initiate such a trade. Therefore, when people are forced to exit at all costs for fear of unlimited losses, it can make for an explosive upside in a heavily shorted stock. This phenomenon of a rapidly rising stock with a large short interest is known as a short squeeze. Thus, short squeezes occur when short sellers frantically cover their positions on a stock. This process often begins as price rises to a point where some short sellers find themselves margin called, as well as others short simply cut their losses and get out. Keep in mind that this is often accelerated by automated orders placed by short sellers who had previously sent stop-loss orders with their brokers or clearing firms in the event of such a rise. Since covering their positions involves buying shares, a flood of buy orders overloads the liquidity available in the stock, causing the price to rapidly rise. Furthermore, this surge upward in turn often triggers additional margin calls and more short covering, inevitably causing more losses as the short squeeze pushes the stock even higher. Keep in mind that short squeezes are more likely to occur in stocks with small market capitalization and small floats, although they can involve large stocks and billions of dollars, as happened in October of 2008 when a short squeeze temporarily drove the shares of Volkswagen on the Frankfurt Stock Exchange from 211 euros to over 1,000 euros in less than 2 days, briefly making it the most valuable company in the world. Obviously, once all of the short sellers were forced out, fear subsided and the price eventually retraced. Now, before we can break down examples of short squeezes and how to trade them, let's first explain some more key terminology which can help find potential short squeezes. Short interest is a term used to define the total number of shares of a stock that has been sold short and not yet covered. When a person sells a stock short, exchange rules mandate that the order must be identified as a short sale, with statistics of the total number of shares sold short kept by the exchange and released to the public once per month. Now, the term short interest ratio refers to the short interest or number of shares sold short divided by the average daily volume from the previous month on a particular stock. This number is interpreted as the number of days it would take to cover or buy back the shares sold short based on the average daily volume. The higher the ratio, the longer it would take to buy back borrowed shares. This often leads to upward momentum for the stock if the short sellers suddenly become motivated to buy back their short positions. For instance, if a stock had a short position of 3 million shares and had an average daily volume of 1 million shares, then the short interest ratio would be 3.0, meaning it would take 3 full days of average daily volume for shorts to cover their bearish bet. If a stock were to have instead just 300,000 shares of average daily volume, then the short interest ratio would be 10.0, meaning it would take 10 whole days of buying for shorts to cover their position. Now, from a contrarian standpoint, buyers can identify stocks with high short interest ratios and use this information to their advantage. Obviously, the higher the number given by the ratio, the more difficult it is to cover in the event shorts are forced to do so. Typically, any number above 5 full days to cover is considered a high number and a potential reverse threat. Thus, should a short squeeze take place, buyers who have done their homework can quickly pounce, creating potential short-term trading profits. Now, this information is a good starting point for finding potential short squeeze candidates because it gives us the answer of who would buy the stock. By recognizing the large short position, we can understand the potential urgency buyers may have, which in turn could be key psychological development behind a buying frenzy in the stock. Now, it's important to note that a short interest ratio by itself is not a reason for buying a stock in anticipation of a short squeeze. As with any other indicator, the short interest ratio should not be used on a standalone basis. The informed trader will have an edge when there is a preponderance of indicators leading to a surge in price. Therefore, short sellers who take large positions are typically sophisticated speculators who have done extensive research on their targeted company and are most often correct. Many times, those who sell short have the right idea fundamentally, but their timing could be off. Therefore, evaluating fundamentals is an important part of identifying a short squeeze, but only to a certain degree. There is no need to divulge into countless reports and calculate tons of data. Simply have an understanding of what the direction of the company is, what the overall sentiment in the stock is, and evaluate if there is any news or earnings that could potentially reverse the mindset of traders. Remember, the time to sell a stock short is when it is either in or entering in a downtrend. When a short position is initiated in a stock that is trending higher, risk dramatically increases. It is easy to be lured into a stock that is continuously moving upwards as thoughts cross your mind that it is up too much and that the PE ratio is overextended, which can tempt you to short the stock. But avoiding that temptation and instead going along with the trend is usually the best thing to do. If the stock begins to roll over and show some true signs of weakness, then contemplate entering short, as now risk is much lower. Thus, on the flip side of the coin, buyers seeking short squeeze candidates look for stocks in an uptrend which have attracted a significant amount of short interest and which also have strong fundamentals. But we can whittle this list down even further through the use of technicals. Stock charts should be studied to see if there is any technical indication that it might be the proper time for a low-risk entry into the stock. Any stock in a comfortable downtrend can immediately be eliminated because short sellers are more confident in a position that is moving in their favor. Eliminating situations that are not high probability candidates frees our time to focus on strong stocks where short sellers may be in trouble. Obviously, if a stock is at a new high, it indicates it is unlikely that any short sellers are in a profitable position and therefore may motivate them to cover their short position. While any stock trading at its highs with large short interest should be on high alert of a short squeeze, equally potent squeezes can potentially occur at key reversal points as well, which can be found technically on a chart. These points include crosses through major levels, such as trend lines or long-term moving averages. Furthermore, a substantial spike in volume at a cross on a chart can also be a key indicator that a reversal in a downtrend to an uptrend is brewing. Therefore, when identifying potential short squeeze candidates, make sure you take a look at the technicals, fundamentals, and the overall short interest. Now let's take a look at a few examples of some short sellers that got caught in short squeezes and highlight where realistic opportunities to profit existed. In this first slide, we see about 10 months worth of data on a daily chart of Humana, ticker symbol HUM. From the chart, we can see that towards the end of February, the stock takes a sharp dive, falling over 50% in less than a month. Furthermore, by looking at the volume indicator at the bottom of the chart, we can see that during this time, volume significantly increased as short interest in the stock grew. Moreover, notice how a level of support came in around $18.50, preventing the price from falling further, which also, in turn, gave traders and investors confidence to attempt a reversal as an uptrend had now formed. From this next slide, we see an intraday 2-minute chart of the same stock, Humana. Since the stock has already begun a fairly successful attempt to retrace some of that 20-point sell-off, short sellers left in the stock begin to get antsy, realizing that the large short interest in the stock is in jeopardy of coming undone. Therefore, when some serious volume came in to buy some shares, short sellers panicked and started covering their positions frantically. Thus, any small covering of shares for any reason, such as a cross of a major technical level, any breaking news, or even a large spike in volume, can spook some short sellers, causing them to cover, which then triggers a devastating chain reaction, forcing even more shorts to cover. So how can you profit from such an event like this one in Humana? Simple. By following your trader checklist that you use every day. There is no need to venture off from your typical game plan in order to significantly profit on a short squeeze. Notice how the stock showed some signs of strength once a breakout through the moving average took place. This break on major volume gave many traders ample time to prepare to purchase the stock through $24, which at the time was the high of the day. Moreover, even traders who failed to identify the great opportunity to enter early still had numerous other opportunities to participate at solid entry points through mini levels that formed along the way, such as at $24.50 and $25.50. With short squeezes, a continuous wave of buying pressure sends the stock upward in price, creating one green bar after the next, as shorts recklessly take out any offers that they can find. Thus, breakouts through any little levels that can form along the way can produce big profits. So, when does the short squeeze show signs that the move is over? Well, notice how the stock made one final spike up over 75 cents through $26 on huge volume, reaching all the way up about to $26.75, which only lasted a few seconds before fading. This spike and fade is referred to an exhaustion print. Often, these huge spikes indicate that the move is temporarily over and price action will reverse, just like in this example. Humana ends up giving back most of the sharp up move once all of the antsy shorts covered their positions. Moving on to the next stock, we see an intraday 1-minute chart of Kinetic Concepts, ticker symbol KCI. From this chart, we see that the stock was comfortably trading at $24 even before negative news came out on the stock, sending it in a free fall. Short sellers, coupled with long sellers, quickly and violently dropped the stock over $2.50 in only 10 minutes. By looking at the volume indicator at the bottom of the chart, we can see the huge increase in sell volume that immediately occurred once the negative information was released. Obviously, short interest during this time rose significantly. However, once the news was confirmed a false rumor, all of those who were short had to scramble to cover, as an aggressive up move was almost certain. Now, as these shorts frantically covered their positions, they took out offers left and right, which caused the stock price to dramatically increase, even surpassing the point at which the stock was trading at prior to the down move created by the inaccurate rumor. As you can see from the chart, the stock actually rose over 7 points from the bottom. Okay, with this last slide, we see an example of what we like to call a minor short squeeze. Now, these occur frequently throughout the trading day in various stocks, when too many short sellers come into a stock and drive it to prices that are not sustainable. By looking at this intraday 1-minute chart of Capital One, ticker symbol COF, we see one of these minor short squeezes occur as a continuous wave of short selling pushes the stock down over $1.25 in less than 1 hour. Now, this selling pressure is great for shorts on the way down, but just like we've seen in previous examples, if and when any shorts cover shares for any reason, other shorts could then get spooked and decide to cover as well, creating a severe chain reaction. In this example, by looking at the chart, we can easily identify that a short squeeze of over 80 cents occurred. Now, there are two great entry points that could have easily been foreseen and can be replicated in future trades by looking at this example. The first being at the cross of the downward trend line at $17.50, and the second being the cross of the moving average around $17.70. Notice how there was literally one green bar after another during the move back up. From these examples, we can see just how violent and dramatic these short squeezes can be as short sellers frantically head for the exits. As a result, buyers who identify these short squeezes early on can profit from these short-term surges in price. Remember though, when looking to participate in a potential short squeeze, always follow your own set of rules that you are comfortable using. Do not lax on your reward to risk ratio in order to find entry points. It will leave you vulnerable for big losses. Instead, stay patient and wait for solid entry points to present themselves. In the long run, that is what will create consistent success.